Alright, Marco Palmero, founder of Ulysses in Dubai. And in this video, I want to discuss with you three strategies, three solutions to invest or buy into a small business. Now, why do I categorize solutions in three main buckets? Well, because we use this as a solution at Ulysses to select and filter investment opportunities based on what are the options available to us and how we can get involved in a certain acquisition. So hopefully they will provide you some guidance, at least an overview of what are the options available when it comes to investing in a small business, buying into a small business. And these three options are, first of all, passive investment or passive acquisition, where you buy a small portion of a business. Then you have an option where you buy into a management group, a private equity group, that then goes ahead and acquires other assets. Or you can buy majority of businesses, more than 51%. So let's talk about these three categories that we use to select investment opportunities. Now, the first is very simple. It's like you look at a business that makes sense to you, and we personally look at opportunities that might want to give away part of the equity in the project. And what we do there is we ascertain whether or not it makes sense for us to get involved as passive investors. In most cases, it doesn't, but for other people, that might be a good solution. So you want to buy into a business and acquire a portion of the business. You can become a passive investor or a passive shareholder, benefit from dividends and profits, but then you don't have to be burdened with the control and with the management of the thing. The owner is taking care of that. Of course, that is something that you can do if you trust the ownership a lot and you believe in their vision and their ability to execute. In all other cases, it might be a little bit risky because, of course, you're not going to have any type of control over the daily operations. Additionally, you might want to buy a small portion to then have an option to acquire majority, but that is a ramification of this option, which I'm going to discuss later on in this video. Now, the second solution is very similar to the first one, but you don't buy into a business directly, negotiating with the owner, but you buy into a company that then has the ability to execute on acquisitions. So there might be private equity groups, venture capital groups, mergers and acquisition companies that do raise funds to acquire certain assets. Now, if you believe in their execution capability and their experience and knowledge in managing these businesses, you might say, okay, I'm going to put money into the project so that they can raise funds. Then they're going to acquire the asset. I'm going to become a shareholder of that asset. But then these new owners are going to manage the business and I'm going to benefit from it. So I'm still a passive shareholder to some extent, but I'm kind of like putting control in the hands of a group that I believe is going to perform. In addition to that, if the deal is structured in a very suitable way for you, you might also get to benefit from subsequent acquisitions that company makes. So there are a little bit of differences between the two models. In the first one, you have a one-on-one interaction with the owner. In the other, you are substantially working with a third party who's then going to deliver on the promise of acquisition and managing of operations. Now, the third and last option is you acquire the majority of the business, so 51% plus, and you can go up to 100%. In that case, you're a majority owner. And, many people might say, well, if I'm a majority owner, I also need to run the business. Well, that is not necessarily true. You can hire management companies that are going to run the business for you, and you're going to pay them a management fee while you collect the rest as dividends or profits. So the options are really open to you. You become full owner of the business, so you can do whatever you want with it. I guess from that perspective, the third option gives you more flexibility, and that's why we prefer it as an option at Ulysses. Generally, we like 100% of buyout, while we consider majority stakes if we want to keep the owner involved for a certain period of time, because that enables us to have that guy involved and vested into the business. And in addition, we might give him an extra bite at the apple, which is something to the effect, if we perform better and you manage to grow with us, then your shares are going to be worth a lot more. So you get to benefit from the new management, making the business even stronger. So these are all ramification of the first three, categories. The point I want to make here, and the reason why we put businesses into these categories, is because it allows us to really filter down which are the opportunities that fit us and which ones are not. From our perspective at Ulysses, we focus only on category 3, so businesses that we can acquire with majority or 100%. The other two don't make much sense. But for another type of investor, a private investor, an individual, that might make perfect sense. And I guess it all comes down to creating a bespoke solution around your needs, because what I've seen is that many times when we make our own deals, negotiate our own transactions, or when we work with other companies to make deals, the strategy is fairly clear because companies do have a vision, they know how to execute, and they know how to want things to get done when it comes to transactions. In terms of working with individuals and private investors, that situation changes a little because it becomes a very personal situation. Depending on what the goals and needs are of that particular person, a bespoke solution is necessary. And that's why there are these three main categories that then are divided in many other small buckets that are kind of like a ramification of these three main ones. And I think that really is the way to look at buying into a business, investing into a business, because it enables you to create the best solution that matches your needs in terms of risk profile, in terms of goals that you wish to accomplish, in terms of money that you want to commit, in terms of window of time that you want to spend within a certain business. So I think these are the three main categories that we use. Once we got that, we filter down based on other criteria, which I'm not going to go over in this video. And this is pretty much it. Those are some of the things that we go through when we work more on the advisory side rather than DealFlow side. And we only take on a few cases per quarter, really, because we're narrow focused on ourselves and a few selected clients. But provided we have slots available, there's a link below. You can check out if you can apply for a slot and work for us through the acquisition process, not only on DealFlow, but also on the advisory side, and see how we can help you structure acquisitions, make purchases, and so on and so forth. Most of what we do is Dubai and Middle East focused, although we also get involved in online businesses worldwide. That's the focus that we take while being sector agnostic when it comes to the region of the Middle East, because we have quite a strong network there in all industries. So if that is of interest to you, you're interested in finding out more about DealFlow advisory for making deals happen, you can check the link below. And these three categories are really the way we use as main selection criteria, a main, I would say, division for all the opportunities, which enables us to then build a strategy in the right way. So I hope that makes sense, and I hope you find this video helpful. I'll see you in the next one.